Good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. A little bit of a late start this morning. We had some IT gremlins, probably snuck in from Cape Town. But anyway, we are all here. From Robert Walton and the entire BCI team, we want to thank you for attending our road shows the past 2 weeks. We will be uploading all the content and the recordings from Pretoria and Cape Town very soon, probably towards the end of the week. On the Boutique Manager's website, but you'll see some communication coming out on that as well. All eyes on the Fed today to see if they will cut by 25 or 50 basis points. This could be beneficial for a lot of asset classes, including things like global bonds. However, there are still some risks lurking in the shrubs, like those around the golf course at West Palm Beach, Florida. Excuse the pun there. People will definitely ask, if they were to cut 50 basis points, why so aggressive? And that might stir some volatility or nerves in the market. Today, we will focus on global bonds, offering super attractive yields, well priced as both a defensive asset and a real return generating asset. As we do continuously, we endeavor to find new asset managers that are experts in their fields and the new stars of tomorrow. Today, no exception, with newcomer to the BCI family, it is my absolute privilege to welcome actuary and CFA charter holder Thaniel Tigere, Chief Investment Officer at Balondolozi Investment, here to share their insights on global bonds, their company, and how they structure the Balondolozi BCI Global Bond Fund. Good morning, Thaniel. How are you doing this morning?
Morning, Eugene. Thanks very much for the introduction. Hope we can leave the rest of the audience with one or two more points regarding global bonds. Thank you.
Yes, looking forward to that. Maybe just in terms for our audience, I know you're going to talk a little bit about your company, but I know you've got a couple of other funds, including a SA bond fund with a phenomenal track record. If I looked very quickly, first quartile type performance. So I think your business might be new to a lot of the audience, but you definitely know newcomer to the investment world. And I think you started investing. I've heard a bit about your story when you were 10 years old. You bought your first fixed deposit, I think, and then ETFs, and then you went to study actuarial science. So you've got a very interesting history as well. So Thaniel, from our side, really great to have you join Boutiques on Wednesdays. And we're looking forward to your introductory presentation. Thank you so much.
Thank you, Eugene. I didn't come alone. I also came with our CEO, Yolandi. I think she will do the introductions before we just a brief overview of our company and before we go into a bit of aspects of our global fund that's in focus today. Yolandi, over to you.
Fantastic. Yolandi, from our side as well, welcome. Thank you so much for joining. Great to have you with us as well.
Thank you, Eugene, and thank you, Thaniel. Thank you for the invitation. This is a big one for us. We are very happy to be a part of this family and just hope that we grow together. So I will start off by just giving you a brief introduction on Balondolozi to speak to the people, our assets, and then I'll hand over to Thaniel who'll speak to the actual product. Thank you. We can skip. Okay, so Balondolozi, just to give you a background, Balondolozi is mainly employee owned. So 49% is owned by the employees of Balondolozi and 51% is owned by the Pedro Samuel Family Trust. Pedro is the founder of Balondolozi. So Pedro and Thaniel, yes, they crossed paths at Prescient. They both studied at UCT and both worked at Prescient, and that's where their paths crossed. So Pedro, the founder, his strength is in equities and balanced funds, and Thaniel is in bonds. Thank you. Briefly, I'll speak to our governance. So these are the different structures. We have a board, and the board is chaired by an independent non-executive director, Masibulele Dem. We've actually split the audit and risk committees. So we have the audit committee, which is also chaired by an independent non-executive, Zanele Mdlegeza, and the risk and compliance is chaired by Zandi Mlambo, also an independent non-executive. The investment team is chaired by the board chairperson, Masibulele Dem, and then the executive is made up of Balondolozi, a team at Balondolozi. So that would be myself as the chief executive, Fanwell, Pedro, Nobuhle, and Karabo. Thank you. And then the team, so we are a fairly small team. Balondolozi was formed in 2010. We received our first mandate in 2012, was an absolute return mandate. It has since changed from absolute return. They changed to balanced, sorry, not balanced, to a bond fund and half in portable alpha, which Fanwell will speak a bit to. So we are a small team. Investment team is headed by Fanwell, who you've given a very good intro to at the beginning. Fanwell takes care of the investment team, and I take care of the business. My role mainly is business development and operations to an extent. Pedro is the chief operations officer, and he's also senior portfolio manager. So Pedro spends more time in balanced funds, and he actually actively manages the balanced fund, while Fanwell oversees the fixed income team. And in his team are Karabo Matsebe and Sindisiwe, who are bonds and money market. In equities, we have Sandali van Veek, and in ESG, we have Alicia Sekwati. And then Nobuhle is our risk manager, and Precious takes care of administration. Thank you. So BE, we are a level 1 BE rated company, 68.97% Black owned and 49.93 female owned. Thank you. Our growth, so we, like I said, we are fairly small. And I mentioned earlier that we got our first mandate in 2012. So we closed the year 2012 at 167 million. And you can see over the years, our growth has been quite steady. We are currently at 11.3 billion. And the next slide or this chart just explains or describes where we are invested. So most of our funds are in fixed income, 49% in bonds, 12% in equities, 4% in portable alpha, 4% in the balanced fund, 8% in the moderate balanced fund, 1% in absolute return. Absolute return being our flagship product. I mean, we started out in absolute return, but we hold just 1% to date, 10% in cash, and 12% in the income fund. Thank you. I will now, so that's just a brief introduction on Balondolozi. Obviously, if you want to know more, we are happy to provide more information. Just in the interest of time, we limited our slides to give Fanwell more time to speak to the actual bond fund. Thank you.
Thank you, Yolandi. I think just to maybe take it a little bit technical, we've had the business, and one of our core aspects as a house is that we are a quantitative investment house. Our philosophy, our belief is that assets from time to time deviate from their fair value. So we just use a quants process to be able to determine value in our assets. So you'll see that the tilt as you look at the global bond fund is mainly we'll just look at the broad economics. Then from there on, we'll touch a couple of aspects on fundamentals, and sentiment or technicals, as some would want to define them. But to go into the fund that's in question here, we just want to look at the global bonds in the 2000s, as in since the late bubble in the late 90s or early 2000s. You'll find that on the slides. We've got the orange line, which just represents the dividend yield of the MSCI, and which I mean, as we started the century, the 2000s, you see that it was around about 2%, and then we've got the blue line, blue-gray line. That's the 10-year Treasury yield. That's just a proxy of where bond yields are over time. So one would be forgiven to think that bonds are not really necessary in portfolios given how they've behaved in the past decade after the 2008, 2007 financial crisis. So with the quantitative easing then, you'd see that bond yields from 2008 were substantially lower than 3. And at some point during the 2010s to 2020s COVID, you see that bond yields were even lower than what equities would give. But since quantitative tightening and the inflation scare we had in 2022, which some say some believe is transitory, and some say maybe it's the start of a new era, you'll find that bond yields now are now substantially higher than the dividend yields. So asset allocators obviously would say equities are expensive, but on the other side, you see bonds relatively offer a yield together with relative safety in terms of them being able to pay the principal. So in general, bond yields were lower in the past decade, but now after 2022, 2023, they're substantially higher than what equities are giving you. Obviously, it's a function of how the Fed is reacting to inflation, and it's a function of where equities are in terms of the valuation. So if we look at the valuations, whether it's the normalized PE ratios or just the normal forward-looking 12-month PE ratios, you see that equities are a bit on the expensive side. So having access to this yield in bonds, it not only gives you diversification, but a real dollar yield that's coming into the portfolio. And with the cuts that are, the chart of cuts being spoken of, you find that you're getting 3.5 to 4 if you use the Bloomberg ad. You're getting more than 4% yield, dollar yield as well, with the protection of obviously being in the dollar in case there's a crisis. So there's a high yield in bonds, and two, relative to where equities are, bonds seem to be giving value. So if we go on to the next slide, other than the yield that we get from bonds, there's the aspect of correlation that's or diversification that comes along with holding bonds. We've got a chart there. It's a bit squiggly lines in terms of one is a rolling 60-day correlation between a global bond index, in this case the Bloomberg AG, with the equity index, the MSCI. So you will find that over a rolling 60-day period, you might be forgiven to think that the correlation is not that steady. But for a fairly long term horizon, the darker green line, the 24-month rolling correlation, it shows that bonds are negatively correlated to equities. So within a global portfolio, you definitely have the benefit of diversification or buffer relative to what equities are doing. And again, I think you look at the past decade from 2011, or I would say maybe 5 years from 2017, it shows that the correlation has been as obviously not as negative as it was. but over the long term, from the start of the 2000s, you see that negative correlation is holding up. I've seen obviously different guys who comment on the bond market. They definitely subscribe to the negative, the positive correlations we've seen in 2022 and 23. But for us using the rolling 24-month correlations, it seems as if it's more of an anomaly than the norm going forward. So bonds offer a good yield in dollars. Bonds also offer negative correlations. So they've got their place in terms of diversifying. So in the next slide, then we just look at the 2020 performance there, how bonds performed during the COVID crisis, especially in March when we had the COVID crash. So you find that bonds, the global bonds, Bloomberg Ag is the one that's in gray, and the other equity indices, the dark blue, that's the FTSE JC All Share Index. Then the orange is the deep orange is the All Bond Index, and then the MSCI All Country Index is the I would say light orange, just to differentiate the two. So what we find there, that's in rands as well. But what I wanted for us just to focus on is the behavior in 2020 when there was a crisis. You'll find that global bonds are the ones that were able to do so well in dollar terms and in rand terms. So this is the same behavior that we see in 2000 and in 2000, then in 2008. So in times where there is a shock in the system, be it from the equity market or from the housing crisis we saw earlier, or the COVID, you see that global bonds provide a buffer. And with where equity prices are at the moment, I think you also want to hedge or to provide one portfolio that gives that diversification. So I think I'm done with just the broad macro. We just want to go into how we think one should position, or the most efficient way, or a relevant way of structuring a portfolio to be able to benefit from the global bonds. Obviously, we're speaking from a manager that's based in South Africa and following a quant process. So we think the best way, just looking at literature as well, is to be able to use a portable alpha process to be able to port alpha from a source that's more certain, and then take the beta from another efficient source as well. But I'll go into the process. So our fund objective there is broadly is to have consistent and measured performance above the global bond benchmark. In this case, is the Bloomberg Aggregate Bond Index. And in terms of that, we prefer to outperform by 1% over a rolling 12-month period. And we do that by combining the strength of passive investing. We'll go a little bit into that. So by taking from passive investing, we are able to lower the fees of the funds to us, and obviously passing on the benefits to the fellow investors in the fund. And the other bit is that the tracking error of our performance is closer to the index. So it's deliberate for us to try and lower the fees, and it's also deliberate for us to lower the tracking error there. Then the other bit now is to use the active strategy to get the 1% over and above the benchmark that we've chosen. And by doing so, we try to use the alpha classes with favorable metrics. I think generally literature says about the equity, broadly managers tend to struggle to outperform the equity bits, or even some of the bond funds struggle to beat their international benchmarks. So we prefer to port our alpha from cash, in this case, South African cash, which surveys show about 75% of the cash managers are able to outperform the cash more than, in fact, I think with recent articles on the managers followed by some of the bigger consultants there, it's almost all the cash managers are able to outperform. So we want to track the relevant benchmark, in this case, the Bloomberg Ag, closely, and pass the benefits of lower fees to the fellow investors in the fund. And the second bit is we still want to outperform, but our performance is just from a source, in this case, cash. That's more certain to reduce again the tracking error and increase the certainty here. So I'll then move on to just describe how then we try to do that in the fund. Here it's just a slide that tries to show where the fund is relevant. We don't want the fund to be active and introduce tracking error. So the traditional one on our left-hand side, the traditional fund or the traditional structure in a couple of funds, there's a core, which is a passive ETF, and then there are satellite managers that provide the alpha. But where we think the portable alpha strategy sits in the portfolios is in the core, in the enhanced core, where we have a passive overlay of low risk portable alpha. In this case, that brings the beta with a bit of alpha. And then in the active manager space, then obviously the multi-manager or the consultant will be able to look for high value the traditional managers there. So we don't want to classify ourselves as aggressive equity, but just an enhanced core, which gives a consistent performance there. In the next slide, just to jump onto the point, as in the anatomy of how we try to get the alpha in the fund there. So we want to get the alpha, yes, but the beta component is also important to us. So I mean, just straight from the book, is if you hold cash and you hold a future, then you should be able to produce an index return. Cash, in this case, provides the money that's needed for margin and obviously the interest, and then the futures provide the beta in this case, and you get the total return. So the portable alpha strategy, in terms of our bond strategy here, we then get the alpha from cash. You will see that the bottom row, cash plus the alpha, that's where we get our alpha using our enhanced cash, Balondolozi enhanced cash. And then we just have indirect exposure using derivatives. In this case, we then make use of we want them to be listed for that transparency and to reduce counterparty risk. And then if we combine the two, we then have our index total return, that's the dividends, coupons in this case, together with the alpha. So we are able to outperform using indirect exposure from our cash process. And we think this should be able to bring the certainty that's expected of the core. Just to, in the next slide, we just want to look a little bit in terms of the portfolio construction. We try to just show the broad processes that we follow there. So in implementing this portable alpha, because that's part of the questions that we've bumped into. First, what we want to do is to select the target market index. In this case, we've selected the Bloomberg Aggregate Bond Index. And then after we select that, we then replicate the index using futures. And then part of the process then is to allocate some of the cash to service the futures, and obviously to provide liquidity in the fund. And then we allocate some of the cash to try and enhance. That's on step two, tries to use some of the cash to then enhance the return of the fund. So broadly, the fund has got 3 cash components, and futures, 1 cash, replicate the index or margining for the futures with the buffers that are required there. The second component is just the reserve to service the liquidity, the requirements of clients, because it's a fixed interest fund where we endeavor to have as much liquidity as is expected of the fund. And then lastly, the alpha bit, the enhanced bit that provides the kick, the alpha that we promise to the fellow investors in the fund there. So by combining cash and futures, you will see that we will have a return that's slightly higher there with 100% exposure together with the alpha component that produces returns higher than the initial starting point. So there's no leverage in the fund, and the alpha again is coming from a more certain source. Then just also to have touch points in terms of how then to try and to give more color in terms of how we then use the index in the next slide. We just, I mean, the selected, it's not as, different people have got a way of getting beta exposure to global bonds or to get exposure there. For us, we prefer the Bloomberg AG. Reason is it's investable. You know, it's a number of securities there, but it's something that you can replicate. So we prefer that because it's something that's investable. And then secondly, it's an index that we prefer as well because of the market cap there. It's well over 10 billion with some of the larger managers that operate ETFs operating in the space. So there's a lot of liquidity, more than 10 million if you look at the various providers internationally. So we think it's something that's investable, it's something that's liquid. But in terms of the futures, we are SA domicile. So the futures that we prefer, obviously, are those that are listed on Yieldx or Suffix to enable mark-to-market and transparency in the pricing there. And the futures, they are very liquid, they are listed, and they are not affected by, they are dividend neutral and tax efficient as well, because tax is also a big thing, given that there's income that's coming from this fund. Then the next bit is just to also, you know, we talk a lot about the Bloomberg Aggregate Bond Index, but we just thought maybe we can give color in terms of what the constituents are there. But like I said, in terms of the size, they are well over 120 billion. The market cap of the funds that track this index. So it's an index which is very popular and very liquid. Just taking a snapshot of the stats, end of August, daily liquidity is 8, but it varies from 8 to 10 million a day. Then in terms of the yield of the index, it's 4.12. So it's slightly higher than what 10-year treasuries are giving you at 3.6. Then effective duration is 5.99, which is roughly comparable to what you get from the OBI, which is slightly lower, but it's not as sensitive to interest rates as it was when the zero interest policy rate was being pursued in the US. Then average maturity comparable, where the main difference is that there are more than 10,000 securities in the index. So there's the diversification that you prefer there. Then the next bit to jump on is the credit ratings of the, just the right side of the previous slide is the credit rating. It's predominantly the US. So you find that the US is no longer, AAA rated. So it's now AA rated. So you find that 72% of the fund is AA rated according to the international rating agencies. So that's the 72 there. And broadly speaking, I think about 44% of the index is the US Treasuries. So you find that, yes, it's US Treasuries at 44, and the mortgage-based securities guaranteed by the Fed, then hence the 72 in AA rated. Then the rest are just corporates with just about 0.52 in cash in the index. So it's something that's predominantly safe for an investor coming from South Africa, and other than the safety, it's something that gives you a yield of about 4%. That's before the cuts today, obviously, and it's in dollars. So if we move to the next slide, there we after remember we're just trying to explain how we structure the fund. So after we pick the beta component, we then look at the ways of investing the cash, and in this case, we just aim to outperform futures, the funding rate +1. Then the cash component duration is less than 365. Maximum maturity of the enhanced cash portfolio is less than 5 years, and credit exposures or counterparty exposures still follow the CISCA guidelines, which is predominant less than 20% per given counter. So I think, in a nutshell, that's how the fund is structured. We then just look at the last two aspects, just why you need to look at the fund, the structure it is as unconventional as it is. In the next slide, the next slide again, just to look at it's something that's not conventional, but just to look at the structure, just a summary there. The duration, like I said, of the fund versus the benchmark is similar, 5.99. The Bloomberg ARG is at 5.93, which is the same. It's then treasury exposure is at 44%, and the yield of the fund hedged back, it's a rand domiciled fund or rand priced fund, but hedged back into dollars, we've got about 5.12% yield compared to that of the Bloomberg ARG of 4.12 as at the end of August there. Then so it's the same duration but a higher yield. So we structured it to outperform by using enhancements based in cash. Then I don't know how much time I've got, Eugene. I've got 2 slides, I think, that I need to touch.
Yeah. Daniel, you're still good. You can continue. It's no problem.
Okay. All right. No, thanks. Thanks a lot. Yeah. So I think just having the benefits of this, just to bring back the thoughts we had initially, global bonds, an asset class that's relevant now, especially the yields that are high. They bring diversification. We obviously use indirect exposure using futures, a combination of futures and cash to get the enhancements and to get the beta. We just think it's something that's of benefit to follow this strategy, given the derivative exposure that we've got and the fixed income capabilities that we've proven to have as a house. But not only do we come with this expertise, we also bring the efficiencies of lower costs into one's portfolios. So the costs are lower compared to some of the active strategies. There's the active bit that comes about, and at times as well, if it's going through an indirect fund, there might be other layers of course that come by. So we just provide direct exposure from South Africa to an international index without having a third party to introduce other fees there. Then the second bit is we structure the fund to lower the tracking error. So it's deliberate for us to have a lower tracking error there. And we just think it's something that helps. So as we do this, we also think that the risk management bit is core to the fund. So underlying futures, they are liquid, and in terms of dividends and pricing concerns, it's something that's solved by having direct exposure and having it listed. So we are quite particular in terms of our interest rate exposure, and we limit maturities in the enhancement portfolios to 5 years. Our duration to the enhancements is also limited, and credit risk is a core thing that we give emphasis to, and we make the exposures quite regular, similar to that of a regular income fund. And on a daily or whatever structures we put up is hedged back to to the pricing is in rands. Our exposure is in a dollar asset. So whatever enhancements we have, we just hedge all our exposure back to rands, so that because currently rands are the funding currency, as in our view is from an investor who's coming from South Africa. So I think that's us. That's the Global Bond Fund, to be able to get the benefit of the high yields that are coming from the dollar bonds, and also to be able to do that effectively with low fees and providing an alpha to the fellow investors in the fund. I think that's us. Eugene, over to you. Thank you.
Daniel, thank you very much for that. And Yolandi, thank you very much for the introduction to your business as well. Interesting indeed. And Fanny, I can see where your love for numbers and mathematics and your actuarial background comes into play. Definitely not the typical bond fund or global bond fund that we are used to. Maybe if I can start there, and it's almost to get a sense, of where to utilize or how to apply exposure to a global bond fund at this point in time. Especially if you look at SA bonds, you also manage your SA bonds fund. I mentioned that in the introduction, doing exceptionally well. But if you look at SA bond yields, running roughly at about 11.2, 11.3. The yield in your fund, if I recall right, 5.12. Why would an investor opt for global bonds at this stage? We all understand, that when you go into a rate cutting cycle, there's obviously a lot of good that can spin through to bonds, and we've seen it over the past 3-4 months with the anticipation of rate cuts coming through in the pricing of bonds. But if you look at SA versus global bonds, and from an SA investor perspective, why would I increase my global bond exposure now?
Okay, no, thanks, Eugene, for the question. I think we just from a broad portfolio diversification aspect, you'll find that equities, global equities, especially if you look at the US equities, the PEs are quite high by several, or just the valuations, so to speak, are quite high by several metrics. If you look at the dividend yields, they're now below the 2%. In the US, and even the MSCI, you'll see that those ones are quite full in terms of rich. The valuations are quite rich. If you look at just the PEs, the MSCI all country weight, those PEs are above the averages as well, 2-decade averages. If you look at that, I think they are between 23 to 25, depending on how you're calculating your forward-looking PE ratios. If you look at that cap 10 ratio, the popular one, where you take the average earnings adjusted for inflation over the past 10 years with the current pricing, those things look rich. So from that perspective, if you still want dollar exposure, but you're a bit nervous about the valuation of global equities, especially the developed markets, or the North America, the US, I think you get to replace your US exposure with still a US asset, a dollar asset that gives you 4% and not the 2% that we're getting. Because obviously to expect capital gains from equities from here on going 10 years, I think it's a bit of a stretch there. But to expect the bond yields to be able to give you the 4% and preserve capital with cuts coming, I think it's a good space to be in. Then secondly, so for a global portfolio with a dollar asset exposure, you want to sit in there. Then secondly, I think like I've emphasized in the times of crisis, we've had 2020 COVID, 2008, and in 2000 as well. You want to sit in global bonds because then it's one of the assets that has consistently been able to give you a buffer or a hedge when all else falls there. Obviously, with gold, there are always debates there, gold and dollar global bonds on where to sit in. But gold doesn't have an income, and there are some instances where gold didn't come to to the rescue when treasuries came in. So diversification, and if you want to be still in dollars and sitting and sitting in high yielding asset, dollar wise,
Yeah, exactly that. And maybe the conversation then should be it's not a case of SA bonds or global bonds. It's more a discussion on your global carve out in the portfolio, be that 10 or 50% of a client's portfolio. If you want to build in something a little bit more defensive, if you're worried about volatility coming down the line, we know US elections coming through. Everybody's going to watch the Fed at the moment. A lot of questions on, if the Fed were to cut aggressively, why are they cutting aggressively? So there's still a lot of risks out there. So I think a very good alternative if you're looking for something a little bit more defensive. And exactly what you said, global equity is a bit frothy. To get some diversification in the client portfolio. I always find it interesting with fixed income managers and global equity managers. They always have a very strong argument as to which one and not the other. But let's park that. I'm trying to understand the construction of your fund a little bit better. We went through a lot of information, and like I said, it's not your typical global bond fund where you just buy into US tips or nominal bonds. You use future structures, and I understand why. It's to get the exposure, and it gives you the optionality of creating a fixed income pocket where you look to generate that alpha. But maybe just from my perspective, just to understand a little bit better, what is the advantages of using futures and what are the disadvantages?
Okay, I think I'll start with the advantages, obviously. Here in this case, coming out of the South African investor, one aspect that we've seen is that for us to have exposure offshore as South African investors is you have to at times go through a third party, and there might be some fees that are introduced by going into a third party fund to invest globally. So we think that using futures is an efficient way because then you are not introducing any other extra fees to go globally. Yeah, so obviously trading futures is way cheaper than trying to go through another third-party fund to see global exposure. So secondly, I think the other advantage is knowing where we are coming from. We slightly small manager, so we want to seek cost-effective ways to reach to these markets. So it allows smaller investors to move offshore without the other extra bits because the exchanges futures trading futures is less than 3 basis points to move in, or to some extent is even negligible. So that's the main thing, that we move offshore without introducing an extra layer of cost. Then secondly is that just the structure of interest rates, the term structure of interest rates allows futures to be more efficient. In this case, what we are trying to beat is that futures have cost of carrying, but money markets, because of the term structure, they've got a way of beating that cost of carry, which is way easier than trying to use duration to pick the portfolio. So they provide us with an alternative way of beating the benchmark, which is structured in the way the yield curve is exhibited in the markets there. Disadvantages, obviously, with futures, it's an asset that's not well understood, and I think it's more perception. And secondly, it's just that when there's derivatives, obviously there's more risk management that's introduced into the firm there. But we think the advantages, obviously, of cost savings warranty this route when going global.
And I mean, you did mention that there's no leverage in the fund, so it's not the case where you're using futures to create leverage in the portfolio. I think it's very, very important that so that risk is still there. Also, a very key focus area in the fund. We are a little bit pushed for time, but I get one more question. There's so much more I think we can unpack on this fund. More specifically specifically, and it also speaks to one of the questions from the audience. I'm trying to understand your currency, because at one stage you said, a part of the fund is hedged back to USD, and right at the end, the fixed income alpha component is hedged back to ZAR. Just clarify for us, from a currency perspective, exactly how does that work? Is it hedged back to ZAR, or if it's currency movements, what's the overall impact on the fund?
Oh, okay. No, thanks. I think I might have confused there. It's
You got me there.
So it's 100% exposure to the dollar. It's so if dollar moves 1%, the fund moves 1%.
Okay.
Let me just clarify that. But then there's obviously that aspect, the cash bit that we said we use to enhance. That cash bit for enhancing is the one that we hedge back to the rand, because the future gives us 100% exposure to the dollar. So we don't want to introduce another currency risk in the cash component, and since maybe that's where maybe I might have lost you there.
Totally get that. So it's that portable alpha part, no currency volatility coming in there, but the bulk of the fund, which is future based, we get the exposure to global bonds, and you've showed exactly that obviously a hell of a lot of instruments there, more than 11,000. You get that kind of exposure, but that's all based USD, so you're getting the feel for the currency movement as well. Daniel and Yolandi, we unfortunately out of time. This has been a very interesting conversation indeed, and a first introduction to your business. As I mentioned to the audience in the beginning as well, the business has been going for a very long time. Yolandi, you've also showed that. And if I look at some of your fund performances, historically, you do understand how fixed income and a lot of these things really work. It comes out in the numbers. It was very exciting to have you on Boutiques on Wednesdays. Hoping to see a lot more of you in the near future. To our audience out there, you know how it works. If you want more information on the fund, how it works, how to get hold of the fund, which platforms, please give us a call or speak to one of the BCI team members. We'll get you in touch with Faniel, Yolandi, and their team as well. Open door policy, they're more than happy to engage with you if you want to know more. Faniel, Yolandi, from our side, thank you so much for joining. We will chat in the very near future. And to our audience, as a quick reminder, next week, Wednesday, 25 September, please join us again where we have All Weather Capital on the call. That's it for this morning. Thank you for your time. Our audience, thank you. And I'll see you next week, Wednesday.